Have you ever looked at a divorce settlement offer and thought, this seems fair, only to find out years later that you were blindsided by a financial hit you never saw coming? You're not alone. The difference between a settlement that secures your future and one that slowly drains your finances often comes down to a few critical, hidden costs that most people never see until it's too late. In this video, we're exposing 3 of the most common and costly hidden pitfalls. By the end, you'll know exactly what to look for and the one question you must ask to protect yourself. If you're going through a divorce right now, I know it can feel overwhelming. The pressure to just get it over with is immense. But please, hear me when I say this. Knowledge is your single best defense. This isn't about creating conflict. It's about securing clarity and your financial independence. My goal here is to be your empowered guide. I'm going to make the complex simple. We're going to break down 3 hidden costs that could be lurking in your settlement paperwork right now. First, we'll talk about the tax time bomb, how an asset that looks equal on paper can cost you thousands more in taxes. Second, we'll uncover the hidden anchor, a major asset that can secretly drain your cash flow for years. And third, we'll reveal the phantom expense, a future cost that most people forget to account for entirely, leaving them financially vulnerable. Hidden cost number 1, the tax time BMB. Let's start with the cost that surprises almost everyone, because it hits you after you think the deal is done. The problem is that not all assets are created equal when it comes to taxes. $1 in your 401k is not the same as $1 in your bank account. Most people see 2 assets of equal value and think it's a fair trade. But the IRS sees it very differently. This happens because we focus on the pre-tax value. Retirement accounts like 401ks and IRAs are tax deferred. That means when you take the money out in retirement, you will pay income tax on every single dollar. A savings or brokerage account, on the other hand, holds money that's already been taxed. Let's look at a hypothetical scenario with Mark and Lisa. To keep it simple, they have 2 main assets, a $500,000 retirement account and a $500,000 investment brokerage account. They decide to split them straight down the middle. Mark keeps the entire retirement account. Lisa keeps the entire brokerage account. On paper, it's a perfect 50-50th split. But let's fast forward to when they retire and need to use this money. Assuming a 20% income tax rate for Mark, his $500,000 is now effectively $400,000. For Lisa, she only pays capital gains tax on the growth. If her cost basis was $400,000, she only pays tax on $100,000 of gain. At a 15% rate, she walks away with $485,000. That's an $85,000 difference from a supposedly equal split. So how do you protect yourself? Your first move is to ask your attorney or financial advisor one crucial question. Can we calculate the after-tax value of all major assets before we agree on a division? This one question shifts the entire conversation from face value to real value. But getting the asset split right is only half the battle. What about the assets that don't just sit there, but actively create ongoing bills? That leads us to our second hidden cost, one that can turn your dream asset into a financial nightmare. Hidden cost number 2, the hidden ANCHAR. This is the cost of ongoing ownership. You fight to keep the family home, or you agree to keep a rental property thinking it's a stable asset. But what often gets overlooked are the relentless, ongoing costs that come with it. The house isn't just an asset. It's a liability until you sell it. This is missed because we focus on the equity. The value of the home minus the mortgage. We see a number like $200,000 in equity and we think, that's mine. But that equity is locked away. To live in that house, you have to cover 100% of the costs that you used to split with a spouse. Let's say you and your ex own a home with a $2,000 monthly mortgage. You keep the house. You also have a car payment, utilities, and groceries. When you were a 2-income household, that mortgage was manageable. But now, on a single income, that same mortgage payment can consume 40%, 50%, or even more of your monthly cash flow. Add in property taxes, homeowners insurance, and the inevitable $10,000 roof repair, and that valuable asset can quickly sink your monthly budget. The actionable step here is to create a post-divorce budget. Don't just guess. Sit down right now and map out your solo income versus all your solo expenses. Can you truly afford to maintain the house, the cars, and the lifestyle on your own? If the numbers don't add up, it may be financially smarter to sell the asset and split the proceeds, freeing up your cash flow for a fresh start. Now, we've covered the costs of the assets you know about. But what about the cost of something that doesn't even exist yet? The third hidden cost is the most insidious because it's completely invisible in your settlement documents. Hidden cost number 3, the phantom expense. This is the future, major expense that you are now 100% responsible for, but that your settlement didn't account for. The biggest, most common phantom expense? Your own health insurance. If you are on your spouse's employer-sponsored health plan, your divorce is a qualifying life event that allows you to get your own plan, but you have just 60 days to do it. The cost of an individual plan can be a massive, shocking new bill that your budget wasn't prepared for. Imagine Maria. She was on her husband's excellent company health plan for 15 years, paying very little out of pocket. In the divorce, she got a fair share of the assets and felt secure. But then she had to find her own insurance. She goes to the marketplace and finds a comparable plan will cost her $650 a month. That's $7,800 a year after tax. That's a new car payment she never anticipated. Her fair settlement suddenly has to stretch thousands of dollars further every year for the rest of her life or until Medicare kicks in. The protection here is all about forward thinking. You must investigate the cost of replacing all shared benefits. This includes health, dental, vision, and even life insurance. Before you sign anything, get quotes for your own policies. Know the real number. This allows you to negotiate for a slightly larger share of the assets or a longer period of spousal support to cover this specific verified cost. You're not being greedy. You're being financially literate. Let's take a quick breath and recap, because this is a lot. First, the tax time bomb. Always compare assets based on their after-tax value, not their face value. Second, the hidden anchor. Before you fight to keep an asset like the house, run the numbers with a post-divorce budget to ensure you can afford the ongoing costs. And third, the phantom expense. Proactively research the cost of replacing benefits like health insurance, so you can account for it in your settlement. Remember, the goal of a divorce settlement isn't just to be equal on a piece of paper today. It's to be equitable and sustainable for your life for the next 20, 30, even 40 years. Arming yourself with this knowledge is how you move from a position of fear and pressure to one of confidence and control. Now I want to hear from you. Which of these hidden costs was the biggest surprise for you? Or is there another one you've experienced that we should talk about? Let me know in the comments below. This is a community, and sharing our knowledge helps everyone. To make this even easier, I've created a free divorce financial checklist that walks you through these hidden costs and gives you a worksheet for your post-divorce budget. The link to download it for free is in the description below. And if you're feeling overwhelmed by the legal process itself, my next video breaks down how to communicate effectively with your divorce lawyer to save time, money, and stress. You can watch it right here. If this video was helpful, please help me empower others by liking this video and subscribing to the channel. Hit that notification bell so you don't miss the strategy